These were not conspiracy theories. Courts proved them true, with verdicts attached. A trader forging signatures to corner a metal market. A bank whose own liquidators admitted, in writing, the bank itself was a crime. Congressmen paid in stock instead of votes. One conspirator spent years recording his partners while stealing millions from the company he claimed to protect. The bank that was a crime. The prospectus called it one of the fastest growing banks on earth. Regulators would later call it something else. Bank of Credit and Commerce International opened branches across 70 countries by the 1980s, courting deposits from governments and drug traffickers alike, while its founder, Aga Hassan Abedi, built a reputation as a visionary banker for the developing world. Behind the balance sheet, the bank covered bad loans with fictional transactions, so each cover-up needed a bigger loan, which meant the fraud had to keep growing just to survive. Auditors flagged false accounts in 1990, and Abedi resigned within days, already recovering from a heart attack that kept him out of any courtroom. Regulators in 7 countries shut the bank down in a single coordinated raid that July, freezing accounts mid-transaction. That December, the bank's own liquidators pleaded guilty to racketeering, running a business that was itself a continuing crime, not a legitimate one that occasionally broke the law, admitting under oath that an institution carrying debts near $10 billion, worth about $20 billion in today's money, had been built to launder cash and hide fraud from the start. Abedi died in Pakistan in 1995, never extradited, never tried. Thousands of depositors in Britain alone never recovered their savings. Decades later, some were still suing the regulators who had licensed the bank in the first place. The bubble that ate London. The company's chief cashier kept the books for a firm that promised to erase Britain's national debt by trading a monopoly on trade with South America. Shares in the South Sea Company traded near £128 in January of 1720. Directors quietly handed free shares to members of parliament and royal ministers, so the men who might have regulated the company instead had a reason to promote it. That is a bribe, a payment made in secret to buy someone's silence or support. Word spread that the king's own mistress held shares, and by June, the price passed £1,000, rising only because buyers expected it to keep rising. The cashier fled to the continent with the company's secret ledger before Parliament could open it. Isaac Newton, who had already sold his shares at a profit, bought back in near the peak and lost roughly £20,000, by later economic history estimates, worth several million pounds today. Parliament's investigation that autumn found the bribery network reached the cabinet. 2 ministers were expelled in disgrace, though the company's governor, a royal relative, escaped punishment entirely. In response, Parliament passed the Bubble Act, restricting new joint stock companies for over a century afterward. The secret buyers. Every broker in the City of London expected Guinness to win its takeover battle for the drinks company Distillers in 1986, no matter what it cost. Chairman Ernest Saunders needed Guinness's own share price to look strong to investors, so a small circle of allies quietly bought Guinness stock using the company's own money, a practice regulators call share support, secretly buying a company's shares to prop up its price during a deal. The purchases worked. Guinness won Distillers, and Saunders became the toast of London finance. Investigators later traced roughly £25 million in secret payments to the buyers, worth over £70 million in today's terms, funneled through offshore accounts so the trades looked independent, which meant shareholders had no idea the company was effectively buying itself. A junior executive's suspicious paperwork triggered the first inquiry in 1986. Saunders and 3 associates, later called the Guinness Four, were convicted of fraud and false accounting in 1990. Saunders received 5 years, then was released after 10 months on medical grounds, diagnosed with a rare, irreversible form of early dementia. He spent the following decades running consulting firms, his health apparently much improved. Doctors who examined the case afterwards still dispute what actually happened to him. Cornering all the world's silver. Nelson Bunker Hunt believed paper money was a fraud, and silver was the one honest metal left, so through the 1970s, he and his brothers began buying it by the ton. Rather than simply holding coins, the Hunts bought futures contracts and physical bars together, so any rival trying to bet against silver had nowhere else to source it, which forced the price higher with every purchase. By late 1979, the brothers and partners from the Middle East controlled contracts on more silver than existed in most national reserves. An ounce that sold for about $6 in early 1979 touched nearly $50 by January of 1980. Commodity exchanges, watching their own member firms exposed, abruptly changed the the rules, allowing only sales, not new purchases, of silver contracts. The price collapsed within days. On March 27, 1980, a date traders still call Silver Thursday, the Hunts faced a margin call, a broker's demand for more cash to cover a losing bet. They could not meet, and banks scrambled overnight to keep the default from taking down the exchange itself. A federal jury later found the Hunts liable for manipulating the market. Nelson Bunker Hunt, once one of the richest men in America, filed for bankruptcy in 1988, still owing hundreds of millions of dollars. Stock for silence. A block of railroad construction shares looked, on paper, like any ordinary investment. Union Pacific's promoters had built a separate company, Crédit Mobilier, to construct their transcontinental line, then build it far above the real cost, pocketing the difference. Massachusetts Congressman Oakes Ames worried Congress would investigate the overbilling, so in 1867 he began quietly selling Crédit Mobilier shares to fellow representatives at face value, well below what the stock was actually paying out. Historians label this a kickback, a payment meant to keep someone quiet. The dividends alone returned close to the full purchase price within months, which meant Ames was not really selling stock, he was handing it over disguised as an investment. The scheme surfaced in 1872 when a newspaper published Ames's own letters, including his note that the shares had gone where they would do the most political good. The House censured Ames in February 1873. He died within the year, his name attached to the scandal rather than the railroad he helped build. Estimates of the padded construction profits run past $20 million, worth more than $400 million today. No one involved ever served a day in prison. The Spy Inside the Cartel. Mark Whitaker had a corner office, a company car, and by 1992, a wire taped under his shirt for the FBI. As president of the bioproducts division at Archer Daniels Midland, Whitaker began recording his own bosses at secret meetings with rivals from Japan and South Korea, where executives agreed on prices and divided the world market for lysine, an animal feed additive, city by city. That is price fixing, competitors secretly agreeing on a number instead of competing for it, and it let lysine prices climb 70% within 9 months of the deal. The recordings ran for nearly 3 years, capturing conversations in hotel rooms from Mexico City to Tokyo. In 1996, agents raided ADM's headquarters with warrants built entirely on Whitaker's tapes. The company pleaded guilty and paid a $100 million fine, the largest antitrust penalty in American history at the time, worth roughly twice that today. 3 ADM executives went to prison, but auditors going through Whitaker's own expense accounts found he had embezzled more than $9 million from the company while informing on it. The FBI's star witness was convicted alongside the men he helped put away, and served the longest sentence of them all, Mr. 5%. Traders on the London Metal Exchange called him Mr. 5% because that was roughly his share of the entire world's yearly copper supply. Yasuo Hamanaka had lost a fortune trading copper for Japan's Sumitomo Corporation back in the 1980s, so rather than report the loss, he began forging signatures and fabricating records to hide it. A naked position, a bet with no insurance if the market turned against him, buried under paperwork that looked routine. To keep the illusion alive, Hamanaka bought so much physical copper and so many futures contracts that he controlled 93% of the exchange's copper warrants by November of 1995, which meant the price stayed artificially high as long as he kept buying, which meant he had to keep buying to protect the price. Regulators grew suspicious, and in June 1996, Sumitomo confronted him directly. Hamanaka confessed the same week, and copper prices fell by hundreds of dollars a ton within days, a collapse that erased $2.6 billion, close to $5 billion at today's prices. He admitted the fraud and forgery charges in 1998 and was sentenced to 8 years in prison. Sumitomo kept the nickname alive without ever quite living it down. The pool that fooled Wall Street. Joseph Kennedy sat with 5 other traders in a single room, all agreeing to buy the same stock at the same hour to fake real demand. Insiders had a name for this: a pool, a small group secretly buying the same stock together to move its price. Pools like this one ran openly on the New York Stock Exchange across the 1920s, and one pool trading shares of the Radio Corporation of America reportedly cleared several million dollars in barely 3 weeks, worth close to $90 million today, before selling out to the buyers their own activity had lured in. Coordinated buying raised the price, rising prices attracted new investors, and their money let the pool sell out at a profit before the price fell back down. Congress ignored the practice until the market collapsed that October and kept falling for 3 more years. In 1932, the Senate's Pecora Commission subpoenaed pool records and forced bankers to explain mechanics they had never had to justify before. Franklin Roosevelt, newly elected, appointed Kennedy the first chairman of the new Securities and Exchange Commission in 1934, reasoning that a man who knew how to run one would know exactly how to catch one. What the hearings actually established was that pool trading itself had broken no law. The same Congress that investigated it outlawed practices like his only months later. A diamond cartel's confession. For most of the 20th century, one company controlled close to 80% of the world's trade in rough diamonds, and it did so by agreement with rival mining firms on 3 continents. A cartel, a group of companies secretly acting as if they were one. De Beers set production quotas, bought up excess stock from competitors to keep supply tight, and coordinated pricing through a London sales arm known inside the trade as the Syndicate. A single sales director in that office decided which countries received diamonds and at what price. And for decades, rival mines simply followed his number. Because American antitrust law treated this kind of coordination as a felony, De Beers avoided operating directly in the United States for decades, running its American marketing instead through outside advertising firms. The strategy held until American buyers and manufacturers began filing their own price-fixing suits in the 1990s, dragging years of internal pricing data into discovery. In 2004, De Beers entered a guilty plea in an Ohio federal court to a single charge of conspiring to fix the price of industrial diamonds, agreeing to pay $10 million, a fine smaller than a single week of the company's typical profits. The plea opened the door to the American market De Beers had avoided for 60 years. The world's most famous cartel bought its way back in with a confession. The number everyone trusted. 16 banks answered one question every morning. What would it cost them to borrow money right now? Their answers, averaged together, became the London Interbank Offered Rate, a benchmark rate, a single number that trillions of dollars in other contracts get built on top of, from mortgages to student loans to corporate bonds. Because traders at those same banks held positions that moved with the rate, some began quietly asking their own colleagues to submit numbers that helped their trades rather than numbers that were true. During the 2008 financial crisis, several banks also submitted artificially low estimates to look healthier than they were. So the rate meant to measure honest borrowing costs increasingly measured neither borrowing nor honesty. Investigators eventually gathered thousands of internal messages in which traders openly thanked each other for favors on submissions. Barclays admitted misconduct first, in June 2012, and its chief executive, Bob Diamond, stepped down days later under pressure from regulators and shareholders alike. Over the following 3 years, UBS, Royal Bank of Scotland, Rabobank, and others admitted their own roles, and combined global settlements passed $9 billion. Regulators in Britain and the United States eventually abandoned the rate altogether, replacing it with benchmarks built from real transactions instead of daily guesses. If any of these deserved more time than 15 minutes gave them, say which one in the comments and subscribe for the next case.